All right, we spoke about the SGX Nifty taking a negative start. Let's take a look at the Asian markets themselves. They're tumbling at the low point of the day as far as the Nikkei is concerned. Investors await clarity on the US-China trade talks, but the big event to watch today will be the crucial OPEC meeting underway in Vienna. So the Nikkei down by about 400 points straight off the bat. We're seeing a fair amount of movement on the dollar-yen as well. So that is something that the street will keep an eye out on. Korean index, that one is weighed in lower by the weakness that we're seeing in Samsung Electronics. So that one's down by about 1% as well as the Straits and the Taiwanese indices. Both of them should come up for you. The US futures indicate another cut of almost 300 points on the Dow. So that is something that the street will keep an eye out on. The SGX Nifty closer to the 100-point mark in terms of a decline, very close to the 200-day moving average of 10,748. So let's see whether we hold on to these levels or not, because yesterday, post the RBI policy meet or outcome of the RBI policy meet, we saw a sharp downtick on our markets from 10,800 thereabouts to 10,750, and we bounced off the 200-day moving average. Let's see where we go from there. But on to some important market opinion coming in. Ayaz Ebrahim of JP Morgan Asset Management says there are no major issues with respect to corporate earnings in India. Speaking to CNBC's Sri Jagaraja, he talks on a whole host of issues surrounding emerging markets as well as the other headwinds impacting global growth.
2018 was not a great year. We know that. If you look at Asia, just in Asia, non-emerging markets as a whole, we're down about 11% year to date. But put in perspective, in 2017 we were up about 33–35%. But yeah, certainly, as you said, some of the more current account deficit countries performed worse. Where do we sit today? And I think, we look at these sort of countries, but if we look at Asia as a whole as well, and EM as a whole, I think there's a few things that we've got to look out for. One is still very key is the US dollar. For good reasons, if the US dollar strengthens, Asian emerging markets underperform because really of two reasons. One, it's servicing US dollar debt, and as we know, a lot of these companies in Asia and emerging markets have corporate debts in US dollar denominated, and their servicing costs go up. So that's one. Second is translation in terms of earnings. As your local currency gets weaker, your dollar earnings gets lower as well. So our view on the dollar is that we are seeing a stabilization of the dollar into next year. And I think that's linked also to the US economy. The US economy, we see sort of tailing off. We don't see any sort of major correction in the economy, but certainly we see, if we look at all the numbers coming out, would suggest it's starting to actually just slow off a little bit. And I think that has implications for the dollar. And if you look at the dollar against other currencies in the world on a real effective exchange rate basis, it is looking a little bit toppy. So I think that's one of the key things that we got to look at into next year. The other things is, I think we got to look at the China-US trade issues, and we look at oil as well. So those are the three components. And our base case scenario in all three, and look, frankly, on the trade tensions, we've got to see what happens. But certainly on oil and the US dollar, we're getting a little bit more constructive vis-a-vis the Asian emerging markets.
And if that is the case, Ayaz, does that put the likes of India in the box seat in terms of countries and markets that have really been taking that to the woodshed? And how much of a valuation proposition do they present? Or are there still risks, especially with India, especially with Indonesia, heading into elections next year?
Yeah, no, very good questions. Look, first of all, on India, the oil prices coming off the way they have is actually a very big positive for the current account issue for India. If we look at corporate earnings in India, it's still one of the better ones around. We're looking at strong double digits. Yes, admittedly, if we look at during the course of this year, some of those earnings have disappointed, but they haven't been a major issue. We still look at earnings recovery in the Indian region, and therefore, yes, we are very constructive on India. I'd say on valuations overall, it's a little bit still expensive. However, you're looking at India on a 3-year view, still looks very good. On Indonesia, I think the Indonesian government has been very proactive in addressing issues in the economy on the macro basis and even the currency. And we're very positive on Indonesia, and we're overweight Indonesia.
Okay, so constructive on India with a 3 to 5 year perspective, but the US market remained closed overnight for the state funeral of former President George H.W. Bush, which was held at the Washington National Cathedral. The ADP jobs data, which normally releases on Wednesday, has been postponed to Thursday, and the Federal Reserve Chairman Jerome Powell's testimony to the Joint Economic Committee of Congress has also been postponed. However, U.S. futures point to substantial declines on inversion of the yield curve, which is a possible sign for the recession in the U.S. economy. Dow futures at one point of time were showing a cut of close to 500 points. Currently, they're showing a cut of around 300 points. Remember, just minutes ago, it was pointing to a 200 points cut. And this comes after the 800-point fall that we already saw in the Dow Jones on Tuesday. So a lot of weakness actually persisting into the global equity markets. In fact, we got the early rates from Hang Seng as well, and that was suggesting a cut of anywhere between 2.5% to 3%. So weakness across Asia as well as global markets. In fact, on that note, let's hear out some opinion from Stephen Parker of JP Morgan Private Bank and Richard Fisher, the former Dallas Fed president, on this sell-off and what is really next for the U.S. economy. Take a look.
The yield curve has been a great indicator about the potential for recession, but not necessarily a great indicator around what you should do from an asset allocation perspective. Stocks generally rally over the last 7 or 8 cycles for the year after the yield curve inverts. And on average, you've seen 20% gains within equities. So we're not making wholesale changes within our equity allocations, but rather taking in some of the risks that we're seeing on the fixed income side of portfolios. And there's a risk-reward trade-off, right? On the upside, we think that if things turn out better than expected, the upside you're going to get from equities is much better than what you're going to see from corporate credit. And on the downside, I'm not so sure that the defensive nature of high yield, and especially some of the lower credits, is going to protect you as much, even in an equity downdraft. We've seen a big move off of the recent historic lows, but relative to the rest of the world, rates are actually look pretty high, comparatively speaking. Now, you have to assume some sort of dollar stability to get international foreign investors to really get excited, but I also think from an equity perspective, if you turn it around, there is a relative trade looking outside of the U.S. into emerging global equity markets where monetary policy continues to be much easier relative to where we are in the cycle here in the U.S.
On that speech, to me, Mr. Powell made an observational comment. The range that's been estimated by the guys that plot the dot plot, remember I was a dot for a long time, for 10 years, is from neutral rate 2.5 to somewhere above 3. Well, he's right. One more move and you're at the lower end of the range. As the Fed is cutting back its balance sheet, next year the federal authorities will issue $1.35 trillion more in Treasury debt. That creates pressure, particularly in the 2 to 7 year space on the yield curve. I think that's why those auctions have been a little bit sloppy. And that in turn impacts how you discount the present value of future cash flows when you're buying something else. So rates are on the directional sign is upward in that end of the curve out to the 10 year.
All right, across the Atlantic, then in Europe, markets ended lower amid rising doubts that the world's 2 largest economies will be able to secure a comprehensive trade deal during the ceasefire on tariffs. This is the US and the China that we're talking about. 1.5% cuts seen on all the frontline indices, closer to 1.2% on the German index. The peripheral markets did slightly better, while the ATHEX as well as the FTSE MIB Italy, both of them ended in the red. They ended in the red by just about 0.10%. The Irish index too losing just 0.6%, so outperforming in the sense that they did not fall as much as the frontline counterparts. In the emerging market space, though, the Russian index was lower. The Brazilian index ended mildly higher. It's been a feeble month for the Brazilian index, but to put things into perspective, from June levels of close to 69,000, the Brazilian index has moved almost 30%. So that is the big mover from the emerging market space, yesterday adding just about 0.5% to its weight.
Okay, so that was about equities, but the world of equities today would be looking at the world of commodities closely because the oil prices are volatile ahead of the closely watched OPEC meeting. Remember, the cartel, Russia as well as other allies and producers will meet in Vienna later this afternoon to discuss cutting output to help shore up prices and curb excess supply. But President Donald Trump has actually taken to Twitter to urge OPEC to continue pumping oil at current levels. In fact, on that note, let's also hear out what experts as well as analysts are expecting from today's meet in Vienna.
Whilst oil markets were very finely balanced, literally a few months ago, policy-led increase in production from 3 major producers, US, Russia and Saudi Arabia has just taken the supply above the demand now. And now, basically, this is the excess that we have in the market, and we will keep going down if OPEC does nothing.
There is concern in the market out there that, President Trump is going to lean very heavily on the Saudis to do nothing. But frankly, I think it's in the Saudis' own domestic interest to pull these barrels. I mean, they essentially oversupplied the market over the summer, and now I think they're going to have to pull those barrels back. A million is essentially where we're going to start from in terms of a cut. I think the question is, do we get up to potentially 1.5 or higher? But I mean, my base case is they pull this thing back by 1 million.
Well, I think there's so many different moving parts. More importantly, where does the Saudis play? Where does Russia play? And of course, the US shale production. You would have to think that at the current point in time, crude prices have been hit massively to the downside. There would be a fear amongst OPEC members that is there going to be a continued slide to 45 for WTI and possibly sub 55 for Brent in the short term leading up to Christmas, which could create, I think, major panic and further suggestions that you could see further softening.
In terms of actual production cuts, I don't see much political will coming from Saudi either. So if Saudi and the Russians both are not politically motivated to have a drastic cut, and certainly the US and Iran trying to put out as much product as possible in the coming months, we probably see an environment where, unless we see drastic action, we're going to have prices fall.
All right, so with that, we take a short break, come back, and we get you all the cues and news you need to know for trade this morning ahead of the sort of moves that we're seeing on SGX Nifty.